in progress.
Good afternoon, everyone. um,
This is the last class before the first test. Any question before we continue the slides? Okay, let me share the screen. So we're gonna first finish the chapter 5, and then we're gonna, if we have time, we're gonna talk about the exam. Okay, can you see my shared screen?
Yes.
Okay, thank you. So last class we basically talked about the forward price, forward value, the value of forward contract, and arbitrage opportunity for case 1, right? Which is the underlying investment assets provide no income. So today we're gonna talk about case 2, which is the investment assets provide a known dollar income. So known dollar income, for example, stock paying dividend, bond pay coupon, right? So in this case, when investment assets provide a perfectly predictable cash income to the holder, such as stock paying dividend and coupon bearing bonds, the forward price. So in this case, we're going to talk about the 3 things. First is the forward price, the value of forward contract, and the arbitrage opportunity. Okay, so we're going to talk about these 3 arbitrage. So we're going to talk about these 3 information in this case. So first, again, we have a timeline, right? 0 and the T, capital T is the expiration date. When we talk about the forward price at time 0, so F0, the formula is similar. You can see very similar. When I0, what is I0? I0, which is the income. So let's use D, because when we talk about stock, that's dividend. So D, the D dividend, which is income. We calculate the income. We do discount income back to time 0. Okay, so when we talk about the forward price at the time 0, so we need to talk about everything at the same time, right? So we discount dividend income in some time and back to the time 0. We call it, that's the present value of income, I0. Okay, so what is I0? I0 is the present value of the income. We need to deduct this, okay, because that's your income. And S0, which is the spot price, if you buy, you're gonna pay that. So S0 minus I0. This is let's say the spot price minus the present value of the income. We're gonna use this as the base to accumulate that back to at the end of the expiration day. Okay, so this is the similar to case 1, but what we added is this, right? If this is equal 0, which is the same as the case 1. Now we talk about not 0, right? So this is the forward price, F0, forward price at time 0. And what about the forward price at time T? So forward price at the time T could be any time between 0 and T. So this generates a formula for the forward price. We can, similar to case 1, we do have a ST, spot price at the time T, and also if there is the dividend between T and T, between after small t but before capital T, if there is a D, we need to discount the income back to T, there is IT. So we do deduct IT from ST, and then continuous compounding from small t to capital T. Okay, so as long as you understand case 1, case 2 is very similar. Just deduct the present value of income. Okay, just deduct the present value of income, and otherwise it would be similar to case 1. Okay, so here let's talk about the price. What about the value? the value of a forward contract in case 2, which is similar to in case 1. The value for forward project at the time 0, F0 always equal 0, always equal 0, no matter it's case 1 or case 2. So the value of forward contract at time 0 is 0. And what about the time t? If it's time t, depend on its long position or short position. Let's talk about the long position. Short position, very easy. Just add a negative in front of long position, right? So let's talk about the short, long position. For short position, it's very easy. Just add a negative in front. So for the long position, we do ST minus IT and minus this. This is very similar to the case 1. Case 1, we have what? If it's case 1, we do spot price minus delivery price, do discounts, right? And if case 2, we deduct the present value of income, okay? The present value of income, we need to deduct that. So this is similar to the price, forward price. So here, this is the for case 1, okay? I just don't want you confuse that. So you can compare these two cases. The difference is what? For case 2, we deduct the present value of investment income. Okay, so next we're gonna talk about example, see how we're gonna use this formula. Example 7, the spot price of investment assets that provides income is $45. The risk-free rate for all maturities is 8%. The assets provide income $4 at the end of first and second year. Okay, so first I would like you draw the timeline. So today is 0, and you're gonna have income at the end of first year and the second year. First year and the second year, and the forward price is 2-year forward contract. So the capital T is 2, right? So this is capital T. So the income you have 2 is $4 in year 1, year 2. Okay, so question, what is the 2-year forward price? So which is ask you calculate the forward price at time 0, okay? At time 0, so calculate that, we do what? S0 minus I0, and then do compounding T, right? Compounding T. S0 we know is 45, but what is I0? So we need to calculate I0. We have 2 investment income. So we're gonna discount this 2 back to time 0 and add together. So how to calculate the discount? We do continuous discount. So should be $4 cash flow. Continuous discount, we do negative R and the T. So the first cash flow is from year 1 to year 0, that's 1 year, right? And the second one, we do discount R times from year 2 to year 0, that's 2, right? So R equals 0.08. You can find the present value of all the investment income first. So tell me what's I0. Find I0 first.
It's I0 $3.43.
Total. You add both together?
Oh, that would be $48.43.
No, I mean the I0. Can you calculate I0 for the first? That's 3.69, and 3.41. So total is what? If I'm wrong, please let me know. Okay. Sometimes I make a mistake in the calculation.
I'm sorry, I just forgot to compound it multiple times instead of one time.
Oh, I see. Okay. So just, yeah, make sure you know, you know the problem, then you can do it correctly next time. Yeah, good. Okay. So I0, you should be able to find two discounts, which is calculate the two investment income discount value, present value, back to time zero. So I0 7.1, and then we can plug in the formula for forward price, and R is 0.08, and the T, this is 2-year contract, so time 2, you should be able to get the forward price.
Is it $32.30?
No, can you try it again?
For
Is it
F0, I got 44.48.
Yes, that's correct. Yeah, so when you do the you can do the question, just double check your answer, okay? Yeah. But in the test, if you give more information, give more details, you're gonna get a partial credit. So that's why I ask you in the test, in the assignment, just to try your best to give the detail of the procedure, okay? How you get the answer, what the formula you use, and what number you plug in, and what answer you get. So if you get the final number is wrong, but the procedure is correct, so you're gonna get a lot of partial credit, okay? That's the example 7 question. No? Okay, example 8. A stock is expected to pay a dividend of $1 in 2 months and 5 months. So draw the timeline. 0 and 2 months, 5 months. The stock price is $50, which is S0. The risk-free rate 8% and continuous compounding for all maturities. Investor just take a short position. Okay, make sure you see the position, long or short. 6 months. Okay, total contract is 6 months. So capital T is 6 months. Question 1, what are the forward price and the initial value of the forward contract? Initial value, we don't need to calculate 0, right? And the forward price at the time 0, what's the forward price at time 0? So before we calculate forward price at time 0, we need to calculate I0, right? We know $1 in 2 months and 5 months. So let's calculate I0 first. I0 calculated by what? The investment income, we do discount back to time 0. So we do continuous compounding, not compound, discounting, which is next. R is 8%. And the first is 2 months, so 2 over 12, right? And the plus $1 discount. That's 5 months, so do 5 over 12. So first, tell me what's I0? What's the present value of investment income? What's I0?
Is I0 $1.96?
Yeah, $1.96 or 1.954. You can keep a 95, that's fine. So the forward price at time 0 should calculate by spot price 50 minus the present value of income 1.954. And then we do continuous continuously compounding, which is interest rate 8%, and the T 6 months contract, so 6/12. So you can find the forward price at time 0. What did you get?
I got $50.01.
Yes, that's correct. That's correct. 50.1 cents. Okay, $50. Yeah. Initial value is 0. Okay, so that's, and also the forward price at time 0. This is the delivery price, right? So that's you need to know. Question 2. After 3 months. After 3 months, so between. Oh, sorry. What did it? After 3 months, which is the example 8 here. 3 months. Okay, so after 3 months later, 3 months later, the price of the stock is the 48. So this is the S spot price. We should not use S. Let's use S 3 months. The risk-free rate 8%. What are the forward price and the value of the short position in the contract at the 3 months? Okay, so FT, capital FT, calculated by. So before we calculate the FT, we need to calculate IT, right? IT, because the first $1 is already passed. We only consider after 3 months, right? If it's already passed, we do not consider. So only one income left. Understand? Only one income left is 5 months, because 3 months after 3 months, the first income is already gone. So calculate the present value of income for IT in 3 months. We just have a 1 left. So $1 and the continuous discounting are 0.08 T. From 5 months to 3 months, how many months? 5 months to 3 months, how many months? This is very important. Some students just confuse this. It's 2 months, okay? Make sure you know how and why. From 5 months to 3 months, because now we are standing at the end of 3 months. So go looking forward, we only have one income, which is at the end of 5 months. So from 5 months to 3 months, only 2 months. That's why we calculate IT. The power is 2. T minus T is 2/12. Can you calculate the IT?
Is it 98.7 cents?
Yeah, it's 0.987 or 9868. Okay, you can use 98 or. Okay, so the forward price calculated by ST minus IT, and then do compounding T, capital T minus small t, right? So ST we know is 48, and the present value of investment income 0.9868. You can use 0.99. That doesn't matter, and R is 0.08, and the T minus T is what? From 6 months to 3 months. How many months? 3 months. Okay, make sure you understand the timeline. When we consider FT, we consider from small t to capital T, not the total capital T. Okay, so what's the forward price? at the end of 3 months.
47.96.
That's correct. Good. 47.96. Yes. And what about FT? FT, this is a short position. So when we consider the formula, we know the long, what is long, and then we add negative. So for long position, we do ST minus IT, right? ST minus IT. And in the formula, I would like to go back to let you see the formula. ST minus IT minus K. The discounting, the continuous discounting only for K. Okay. In the previous semester, some students do like this: ST minus IT minus K, and then a lot of students do this. So I think this is the mistake. Like a lot of students may do this. So I would like to point out this. This is wrong. Okay. You see the difference. Okay. Please see the difference. This is wrong. The discounting just for K, not for ST and minus IT, okay? Okay, so let's go back to the question. So we do ST minus IT minus K, do continuous discounting T minus T. ST is 48, minus IT is what? IT we find 0.9868. And minus K, what is K? 50.01, and the times discounting R 0.08. How many months left? 3 months, 3/12. Okay, you can do the calculation. Make sure, okay, discounting just for K, not for S0, ST minus IT.
Is it $2?
Yeah, yes. You should get the $2.01 or $2. Yes, that's correct. So please, I keep on saying, make sure you understand this formula, okay? The discounting just for K, not for the ST and the IT. Discounting just for K. So make sure you understand the formula. Okay, next we're going to talk about arbitrage opportunity for case 2. Arbitrage opportunity for case 2, very similar case 1. The difference is what? We have actions in the middle as well, because you're going to receive income in the middle, okay? So let's see. Question? I think, okay. So before we summarize the action, we have an example for that. What is arbitrage opportunity when a 9-month forward price is out of line of, with the spot price for assets providing known cash income, assets price 900, forward price. So this is market forward price. This is market forward price. 910 income. We have income in 4 months and 9 months. So if you draw the timeline, 4 months and 9 months, the contract is 9 months. So 9 months is at the end. And you have a $40 income, you have 2. And the interest rate you see different for different months. 4 months, 3%, 9 months, 4%. Ask you what's the arbitrage opportunity. Okay, so first step, we're gonna compare the market forward price and the estimated forward price, similar to what we did in case 1. Market forward price is 910. And what is the estimate forward price? Estimate forward price, we do S0 minus I0 and do continuous compounding RT, right? So what is I0? You need to calculate I0 based on the two income. One is 40. 40 we discount back to time 0, which is negative R. For 4 months, the R is 3%, so 0.03. And the 4 months go back is the 4 months for over 12, and the plus 40, same thing. And the negative interest, the risk-free rate for nine months is the 4%, and from 9 months to back to time 0 is 9 over 12. Okay, so first please calculate the I0. What is I0?
Professor, so the asset provides 2 dividends of $40, one at 4 months and one at 9 months?
Mm-hmm. Yeah.
Oh, okay, because it only says 1 at 4.
1 for 2 income $40 occur. Oh, hold on. I think I made a mistake. Give me 1 second. Yeah, I made a mistake. You are right. So only 1. Sorry. Yeah, I saw. Yeah, only 1. You are right. So the income $40 occurred at this 4 months and 4 months for 9 months. Okay, yes, you are right. I made a mistake. Just the 1 income $40. So what's the present value? Sorry about that. Just 1.
I0 is 39.60.
Yes, 39.6. Okay. Once you get the present value of income, just plug into the forward price formula. We have a spot price today is spot price 900 minus 39.6, and then do, because we consider the whole 9 months, so 0.04 and 9 over 12. So find out what's the forward price, estimated forward price. What's the forward price?
$886.60.
Yes, that's correct. Yes, that's correct. And then we compare to the market forward price. Which one greater? So market forward price greater. Okay. So our action would be buy low, sell high. So buy low, which is the right hand side. We're gonna buy assets, right? So action today. First, buy assets. Buy a unit of assets. We're gonna need how much? $900, right? We're gonna need $900 to buy assets. But like case 1, we're gonna borrow money to buy, right? Borrow money to buy because you're gonna have a income in 4 months. So we're gonna do 2 loans. We're gonna do a short-term loan and a long-term loan. Short-term loan 4 months, long-term loan 9 months. So we're gonna borrow 2 loans. So we're gonna borrow 39.6. How to get that from the income, present value of income? So this amount accumulate for 4 months, which is the $40, and exactly you receive $40 at 4 months, you can pay this loan. Okay, so that's why it's the 39.6 for 4 months. And another long-term loan, the long-term, because you need a $900 total, so the difference, which is the for long-term loan, so $860.4 for 9 months. So how to get that number? The difference between 900 and 39.6. Okay, so you're gonna have 2 loans. You're gonna have 2 loans, and then you're gonna do a short, right? Take a short position, which is sell a forward contract, and the price is what? The price is market price for 910. Okay, that's action now. And then we have action in 4 months. which is what? Because you have income, so you're gonna receive $40 income from the company. And also you have a short-term loan, so you're gonna repay, use the $40 to pay the loan, right? So you're gonna pay what? Pay $40. How to get $40? Your principal is 39.6 and accumulate for 4 months, which is the $40. You can double check 0.03 and 4 months for over 12. So that exactly equal 40. Okay, so you basically receive money, which is income at the end of 4 months, $40 to pay the short-term loan. And then action in 9 months. First, you're gonna repay the you have a short position, so you're gonna sell the assets, right? Sell the assets. You have a short position. You sell the assets for how much? 910. That's the money you're gonna receive, and then you need to repay the long-term loan. Repay the loan, and the amount how much you're gonna pay. The principal is $860.4, and you continuous compounding. R is 0.04 for how long? 9 months. Okay, so what is the amount you're gonna repay? And the profit, which is the money you receive and the money you pay. The money you receive is 910, and the money you pay is what? I think this is the amount you're gonna repay for the long-term loan, right? You see, so the amount you're gonna pay long-term loan is 886.6. So the difference is the profit. The profit is what?
$23.40.
Yes, that's correct. So this is the answer. You see the case 2 is a little bit complicated, right? But it's similar to case 1, as long as you understand buy low, sell high. But for case 2, you have, because you have an income, so you have another action in the middle. So action is what? You receive money and you're gonna pay the loan, right? You have 2 loans. So this is talk about the case when market forward price higher. We're gonna do this actions. So in your assignment and in your test, I would like you to list actions like what I did in class. Okay, you need to show step by step and show me how you think about it.
Professor, where did you get 860.4?
A60.4. Okay, so A60.4, how to get this? This is based on the money you need to buy the assets, you need to pay $900, right? And you can borrow a short-term loan is 39.6, the difference.
Okay.
Okay, that's example 9. So example 10 talk about the other case when market forward price lower, then what would be our strategy? So this case pretty much similar. You can see the asset price same, the income same in 4 months, and the interest rate, risk-free rate same. So we can quickly do this. We have a 4 months, 9 months. We have an income 40. And you can go back to check I0. We got from the example 9, which is the is what 39.6, right? You can check the calculation we did in example 9, similar. So, and then we can find the forward price, estimate forward price, which is S0 minus I0, and do compounding. That's also same. We got from example 9 is 886, right? 886.6. Okay, so these two, same as the example 9, you can double check, okay? And now the market forward price is what? It's $870. And we estimate the forward price is $886.6. So you see the relationship. The estimated forward price higher. So in this case, we're gonna buy low, sell higher again. So we're gonna buy what? Buy the left-hand side, which is market forward price. So action now is you're gonna long forward contract for what? The forward price, the market forward price is $70. Okay, and then you're gonna short right hand side. So you're gonna sell the assets for the assets price is what? $900. Okay, you received $900. Then this is the income. You're gonna do 2 investment. In case 1, we did 1 investment, but here we do 2 investment. One is long term, the other is short term. So long term, short term, because you're gonna take short position on the assets. So rather than you receive money $40, you're gonna pay. Okay, so for the short position, this is your liability. Okay, rather than income. For short position, this is your liability. So which means in 4 months, you're gonna pay $40. So to be able to pay this $40, we can invest at the time 0, how much money you invest? $39.6 you invest today. And in 4 months, you're gonna receive $40 for the short-term investment, okay? And the other difference, the difference between 900 and the $39.6. So this is the A60.4. This is the amount you can invest for 9 months. Okay, so that's the action now. And the action in 4 months. First, you receive income from short-term investment, right? You receive $40. How? 39.6 accumulate 39.6, you do continuous compounding, 0.03 times 4/12. You can see exactly $40. And you're gonna pay this amount, right? Because you take short position on the assets, you're gonna pay $40. You have a liability. So that's short, that's 4 months. And action in 9 months. First, you take long position on the contract. That means you're gonna buy assets. Buy the assets for what? The amount is $70. And you do investment, long-term investment. So you're gonna receive investment income. Receive the principal is A60.4, and you do compounding for 9 months. So this is amount should equal AA6.6. You can double check. So this should be the same calculation. And then the profit, which is the amount you receive and the amount you pay. The amount you receive AA6.6 and the amount you pay is A70. So what is the profits? What is the profits?
16.6.
That's correct. 16.6, that's the profits, okay? So you can see case 1, case 2, very similar. The difference is what? For case 2, we have either 2 loan or 2 investment, right? Because in the short term, you're gonna have a income or you're gonna have a liability. So we can do, we have 3 type of actions. So in in the assignment and in the test, for the arbitrage opportunity, I would like to see your actions. Okay, 1, 2, 3. Show me detail. If you didn't show me detail, just give me the profits. You might just get 1 point. Okay, so the make sure you when you study, make sure you understand. Okay, you don't need to memorize. As long as you understand, I think you can write. Use your own words. And in the test, if you are not familiar with the material, even you look at the slides, you probably won't be able to finish the test on time. Okay, summarize. We talk about arbitrage opportunity. We talk about 2 cases, either market price higher or market price lower. So arbitrager can log in a profit by either buying the asset, short the forward contract, or short the assets, take long position in a forward contract. So that's about the case 2, the arbitrage opportunity. The material in this chapter is a little bit complicated, so you really need to spend time, okay, to digest, to understand all the material. You can go back to watch the video and see how we solve the problems in the slides, okay? So last slide, forward price and the future price. So far we talk about forward price. When the maturity and asset price are the same, then the forward price and future price are usually assumed to be equal. When interest rates are uncertain, they are in theory, they are slightly different. A strong positive correlation between interest rate and the asset price implies the future price is a little bit higher than the forward price. So if the negative correlation would be opposite, reverse. Okay, so for this chapter, as long as you know how to estimate the forward price, I think that's good enough. That's all for chapter 5. Any question?
Professor, could you go back 2 slides to
Yes.
where you saw the,
2 slides? Which one? This one?
no, the one before?
This one?
Yeah.
Okay. So we finished all 3 chapters, chapter 2, 3, 5. So that's material we're going to cover in the first test. The first test, we're going to have 2 types of formats. One is multiple choice question. We have a 5, and the other we have a 3. We have 3 comprehensive questions. Like for example 10. This is kind of one comprehensive example. Okay, a question. Are you all set with the slides?
Yeah, I'm all set. Thank you.
Okay, sure. Okay, so let me share you the my course. So this week you need to finish the homework, okay, by the due day, which is the end of Sunday. You need to finish the assignment, and you need to also this week you need to study material, study for exam. The first exam will be next Tuesday, okay? Tuesday, not Monday. Monday is holiday. We don't have class Monday. So Tuesday follow Monday schedule. Our test will be 12. So you need to, at the 12 o'clock on Tuesday, you need to log in Zoom, our Zoom meeting. You need to turn on the camera for the test and keep your computer unmute. So please find a quiet place to do the test. So no talking during the test like in classroom. This is closed book, closed notes. You can use formula sheet, but no cheating sheets. The test does not allow back checking because my course does not function well on the option. So please complete the question by question. Do not go back, okay? If you go back, you're gonna get error. You're gonna you have to redo everything, okay? Review sheet, formula sheet, I posted here. You need to go through the review sheet, okay? When you study the material and the formula sheet, my suggestion is either you print out the formula sheet or you handwriting on the paper write down all the formulas, okay? Because the test will be online. It's not convenient to check the formulas online and do the test online. I think save time. Just have have formula sheet on your hand. Okay, so that's the formula sheet, and you have a 50 minutes for the test. So if you didn't study well, you won't be able to complete on time. Okay, so I suppose you study well and you can finish the test on time. In my experience, like in the classroom, a lot of students can finish in 30 minutes. Okay, so some students can finish in 30 minutes. So if you just check slides during the test, you won't be able to finish the test. Okay, but our tests have to finish in 50 minutes, and the test is designed, which is you can finish in 50 minutes if you studied the material. Okay, any question you can email me and we can discuss anytime. Okay, any question? So you have to find a quiet place, turn on the camera, and do the test on my course. I'm going to open the test when we start. So no makeup, okay? No makeup test will be accepted unless you emailed me in advance before the test. Any question? You need to study. My suggestion for the test, you need to study all the question in the slides. All the question in the slides. You need to go through the assignments, especially the question you didn't get right correct. Okay, so make sure you understand all the problems. The question in the test would be similar what you did in the assignments. So as long as you know how to do those questions, you would be fine. Okay, so that's what I'm gonna talk about the first test. Any question? Any question? I hope everybody study well and do a good job. The test is 25%, right? So it's a lot. Please work hard for the test. Okay. Any question?
No questions, Professor.
Okay, good, great. If you are not sure anything about the test, let me know, okay? So I'm gonna see you guys next Tuesday, okay? So do your assignment and prepare well for the test. That's all.
Thank you.
Professor,
Yeah,
Have a great weekend, Professor.
Thank you.
yeah, you too. Yes.
I was 2 minutes late to class today. I just wanted to make sure that I still got credit for attendance.
Yeah, sure. As
Okay,
long as
thank
you, yeah. So please catch up if you missed anything. You watch the video again. Okay.
I will. Thank you.
No problem. Okay. Have a good day. Bye.
Bye.
See you guys next Tuesday. Bye.